Warren Buffett once bragged that he pays a lower tax rate than his secretary. Donald Trump openly admitted to paying nothing for years. And Robert Kiyosaki proudly tells anyone who will listen that the ultra-wealthy simply do not pay taxes. Now, when most people hear that, they get angry. They think the system is rigged, that the wealthy are cheating, or that there is some dark secret hidden in the tax code. But as a financial professional, let me tell you the cold hard truth. They aren't breaking a single law. They are using the tax code exactly as the government designed it. And recently, that system was rewritten to work even better. What if you could stop being a victim of this system? What if you could flip those exact same rules to build what I call a perpetual Bitcoin machine, a legal shield that takes the money you would have sent to the IRS and automatically converts it into the fastest appreciating asset in human history year after year without spending a single extra dollar out of your own pocket? Today, we are pulling back the curtain. I'm going to show you why the government actually wants you to do this, how the math works, and the exact steps to build your own shield. But before we talk about the machinery, we need to address the real villain in your retirement. You worked 40 years. You sacrificed weekends, skipped vacations, and watched your salary get chipped away month after month. You played by their rules. But now that you're approaching the finish line, the IRS is waiting to take up to 30 to 40% of your hard-earned distributions. It makes me furious to see good hard-working people watch their retirement dreams shrink because of taxes. If you believe that a lifetime of honest labor deserves a protected, abundant retirement, not a constant struggle against shifting tax brackets, do me a favor. Hit that subscribe button right now. Let's build your blueprint together and keep your money exactly where it belongs, in your hands. Let's start with the basics. If you earn income, you owe taxes. Let's keep the math simple for this video. Let's assume a flat tax rate of 30%. If your income is $100,000 at a 30% tax rate, your taxes owed are $30,000. You lose $30,000 right off the top. You are left with $70,000 to live on, save, or pass down to your children. But how do the wealthy turn that $30,000 tax bill into $0? It's not a loophole. The IRS doesn't hand out favors to billionaires just because they're rich. The tax code is actually an incentive guide. The government cannot build affordable housing, create millions of jobs, or build energy infrastructure on its own, so they write rules to reward you for doing it for them. And their favorite reward is called depreciation. Let me explain this in plain English. Normally, if you earn $100,000, you pay taxes on $100,000. But if you can show the IRS that you had $100,000 in depreciation, which is the paper loss from wear and tear on assets like real estate or equipment. It cancels out your income dollar for dollar. $100,000 of income minus $100,000 of depreciation equals $0 of taxable income. Your tax bill drops from $30,000 to absolute zero. Sounds beautiful, right? But for decades, this game was reserved for the ultra-wealthy. Why? Because to get $100,000 in depreciation, you had to own millions of dollars in real estate. A standard residential rental property depreciates over 27.5 years. If you buy a $1 million property, your annual depreciation is $1 million divided by 27.5, which is approximately $36,363 per year. That's a decent deduction, but you had to tie up massive capital, deal with leaky toilets, chase down tenants, and handle costly repairs, all for a modest 6 to 8% return. And if you only have $100,000 to invest, your annual depreciation is a measly $3,636. That barely scratches your tax bill. But a few years ago, the rules changed. The Tax Cuts and Jobs Act introduced something called bonus depreciation. Instead of waiting 27.5 years to write off an asset, the government allowed us to accelerate that timeline and deduct massive chunks, sometimes 100% in year one. And this does not just apply to real estate, it applies to capital equipment. This is the unlock that changes retirement forever. When most people think of capital equipment, they think of tractors, delivery trucks, or heavy machinery. And yes, you can buy a heavy SUV and write it off, but an SUV is a liability. It depreciates, it sits in your driveway, and it doesn't feed your family. What if, instead, you bought capital equipment that literally prints cash flow and stacks the hardest money on earth? I'm talking about Bitcoin mining machines. These aren't speculative tokens. These are specialized high-powered computers. They process transactions on the Bitcoin network and earn newly minted Bitcoin in return. Because the IRS classifies these machines as 5-year computer equipment, they qualify for bonus depreciation. Let's look at the math. Let's say you have $100,000 in taxable income. Instead of giving $30,000 of it to the IRS, you purchase $100,000 worth of Bitcoin mining equipment. Using bonus depreciation, you write off the entire $100,000 in year 1. Your taxable income becomes zero. Your tax bill vanishes. You keep the $30,000 you would have sent to Washington, but instead of a depreciating asset, you now own a fleet of machines generating digital gold every single day. Let me ask you a quick question, and I want you to be honest down in the comments. If you had to choose between dealing with a tenant who won't pay rent or owning a computer that silently mines Bitcoin in a secure facility with zero landlord headaches, which one would you choose? Type real estate or Bitcoin below. I read every single comment. Now, as a certified financial planner, I don't believe in theories. I believe in hard, cold numbers. So I modeled this entire strategy out on a spreadsheet to see how a $1 million commercial scale project performs over a 36-month period. Let's jump into the model. Right here, we have our starting variables. We have Bitcoin priced at $125,000, which we recently crossed, and our starting network difficulty. If we look at the monthly breakdown, our machines are mining approximately 3.3 Bitcoin per month initially, even after factoring in electricity, hosting fees, and operational expenses of about $44,000. Look at this net number. Net mining proceeds are approximately $42,000 per month. Show me a single family rental property on Earth that will yield $42,000 a month on that capital. It doesn't exist. If we project a conservative growth curve where Bitcoin reaches $278,000 over the next 3 years, this model shows a total of 17 Bitcoin mined, resulting in a net profit of over $2,325,000, a staggering 253% return on investment. Now, I don't want to overwhelm you with every single cell of this spreadsheet right now. Because I want you to have the exact same tools the wealthy use, I am giving you this entire Excel model for free. You can download it using the link in the description below, plug in your own income, change the Bitcoin price assumptions, and run your own numbers. But do not click that link just yet, because we haven't even gotten to the best part. If you are just spending $1 to save $1, that's beginner thinking. The ultra-wealthy use leverage. What if you financed those mining machines? Whether you use a business line of credit, a home equity line of credit on an investment property, or borrow against your existing assets. Let's say you secure $100,000 to buy the miners using none of your own cash out of pocket. You still get the full $100,000 tax write-off in year 1. You have zeroed out your tax bill using $0 of your active cash. And the machines are immediately generating Bitcoin to pay down the debt and build your net worth. This is how we turn a simple tax deduction into a perpetual Bitcoin machine. First, in year 1, you purchase the miners, take the 100% write-off and wipe out your tax bill. You take the cash you save from the IRS and buy raw Bitcoin or pay down the machine debt. Second, in year 2, your machines have been stacking Bitcoin all year. Instead of selling that Bitcoin, which would trigger a capital gains tax, you borrow against your Bitcoin tax-free. You use those borrowed funds to buy more miners. You write off those new miners, wiping out your year 2 taxes. Third, in year 3, you repeat the cycle. You are using the government's own laws to subsidize your wealth. The tax money you used to hand over to the state is now building a legacy for your children and grandchildren. No tenants, no maintenance, no midnight calls about a broken water heater, just pure, programmatic, legal wealth preservation. My friends, retirement isn't about just surviving, it's about thriving. It's about ensuring that the fruits of your labor belong to your family, not a bloated government agency. You have 2 choices today. You can keep doing what you've always done, handing over 30 to 40% of your hard-earned income every single year, hoping the system takes care of you. Or you can learn the rules of the game, build your own perpetual machine, and force the tax code to work for you. If you want to download my exact forecasting spreadsheet, see the step-by-step walkthrough of how I set this up, and look at the actual hosted mining vendors I trust to manage the hardware for me, click the first link in the description below. Just a warning, if you want to apply this strategy to protect your income for this tax year, the IRS rules require these machines to be deployed and operating before the end of the calendar year, which means your runway is about 30 to 45 days. If you miss that window, you'll just have to pay the full tax bill this year and try again next year. And if you want to understand the bigger picture of where this asset is going and why I believe a $1 million Bitcoin is actually a conservative projection, go watch this video right here. The Bitcoin Blueprint, why 1 million is bearish. I'm Warren Greystone. This is the Retirement Blueprint. I'll see you in the next video.